Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios here in Mumbai. I am Prashant, as always, with me, my colleagues Sonia and Surabhi. Guys, hi. Morning.
Hi, good morning, Prashant. Good morning, Surabhi. And today's going to be an important day, right? Yesterday, you saw that knee-jerk reaction post all the data that came out of SVB Bank as well as the Signature Bank. But today is going to be a real test of whether that downtrend continues. For starters, at least, the SGX is quiet this morning.
Yeah, it's got a bit of a bounce, a bit of a green.
I can just say that this wasn't planned, viewers. Prashant and I are in shades of white. We're not trying to be the doves here, but it's just coincidence. Just putting that on the table.
I mean, I just wear what they give me. So,
Same here.
but I'll tell you what, guys. This is financial history being made tick by tick, right? We live, as they say, may you live in interesting times. And I think this is as interesting as it gets. Sometimes painful, though, as well, right? So let me just quickly run you through what's the latest that you need to know as we start another session. So hugely volatile day on Wall Street. I think that's point number one. The rates market saw a huge sell-off. I mean, the two-year yield fell 47 basis points. It's on a 3-day time frame. I mean, if you count the amount that the two-year yield has fallen in a 3-day time frame, it's the largest fall ever. It's the largest 3-day fall in history in the US. So it's gone from basically 5% to 4% just like that. By the way, the intraday low was 3.9 something. So it fell actually below 4% and then came up 2 here. Which means that the market has completely priced out the sort of March rate hike. Not just with the Fed, but with the ECB as well. You know, the rate hikes have vanished. That at least the immediate next meeting pricing has completely vanished. So with yields plunging like this, what's the pocket of market which does the best? It's tech, right? I mean, Nasdaq went up about 0.5% or so on the plunge in yields, and there was a little bit of stability in that part of the market. Actually, I would say the broader market stabilized a little bit. I mean, they came off. I mean, equities came off a little bit off the lows, and the stocks did rebound. Generally, Nasdaq, of course, did a little better. But this is not to say that the bank contagion fears are not there. So if you look beneath the surface, the indices, the major indices of the S&P, the Nasdaq and the Dow, they're okay. But the contagion fears continue to fester. And to that point, you look at there is a good measure of the overall sort of listed banking universe in the US. That fell 7%, actually 11.6%. That was the overall bank index. There is a good measure of the regional bank index, which is where the problem is. Signature Bank, Silicon Valley Bank, these are all regional banks. And an index made up of these banks fell another 7% after falling for the last 3 sessions straight now. So the banking problem, banking contagion problems continue to fester. We'll discuss this. This has been the main discussion point here. Now, investors today will await the February CPI data, inflation data. Had we not got this entire Silicon Valley Bank fiasco, it would have been jobs data, a market which was inconclusive, and then you basically would have waited for the CPI, which would have been the decider. But for the CPI to be able to change direction in any meaningful way, the bar is very high now. I mean, it really needs to be a huge beat for markets to price those hikes again. I mean, price in those hikes again. It's priced out the hikes, but for it to say, well, in March, we will see hikes, the CPI number needs to be a blowout. So the bar for surprise from tonight's data is very, very high. Just 2 points on the local market here. I mean, I think with all that is going on, I mean, this is a very interesting market, so much debate, etc. going on. That does not necessarily mean that you need to jump in and trade the market all around. It's very volatile, and it can be very unprofitable as well. I would say this is a wait and watch market. Just to put some levels there, for the Nifty, I mean, we basically closed below 17,255 level. It indicates a fresh breakdown. And unless we are able to come up back above this level, the downsides open up to 16,950 levels, which is not very far away with the pace that we've been keeping. On the Bank Nifty, we need to see a recovery above the 39,750 level, which is basically the big support that got broken yesterday. And unless that happens, the downsides open up to the area of around 39,300 or so. It's, as I said, we live in interesting times. On the one hand, you've got the Fed, which is trying to fight inflation. And on the other hand, it is trying to save the banking system. And the question is, what is priority for the Fed at this point in time? Right now, I mean, I thought yesterday's fall in the Nifty, the market here was excessive, perhaps a little unwarranted as well. We did see a 70, 80 point recovery yesterday. You can look at Asia this morning and say, well, it's all in the red. But the fact is, Asia was higher yesterday when the market here sold off quite aggressively. So we may have paid our fees yesterday to some degree, more than some of the other Asian markets. So, I mean, I'm not saying that all is well and, you should go straight in. But the fact is, it could get better. No one knows beyond a point. But with what we know, the information that we have, it is perhaps possible that this gets contained. The contagion fears themselves get a little contained and we get to normal kind of markets in the coming days. Sonia.
You said we live in interesting times 3 times already. So are you sure you're... this is not a precursor, it's not a lull before a storm or something?
I thought we went through the storm, Sonia. Now we need some lull.
Prashant, you're saying interesting times, and that got me thinking, what are the odds? There have been only 2 bank failures in US history. At least Prashant and I have commentated on both of them. Washington Mutual in 2008 and now this. Who would have thought it? In one lifespan in the history of the United States.
Yeah.
Okay, and hopefully there won't be any more, right?
Really, yes.
But I mean, the point that we were making yesterday as well, the market was weak in any case, whether SVB or no SVB,
Exactly.
right? The Indian markets were trending lower. It just needed, I guess, that little bit of a nudge, and then it sort of fell off the cliff yesterday, and that's pretty much what happened. This morning, yes, the SGX Nifty is indicating that the start will be in the green, but let's not forget that the market has sliced through a lot of key levels. Yesterday, we hit a 5-month low. In fact, there was large selling by FIs for a second straight day, so that seems to be a bit of a concerning factor. In the last 3 sessions, FIs have withdrawn over 4,000 crores in the cash markets alone. And, a lot of things, right? I mean, there is a snowball effect that's happening, not just in the US markets, which have fallen for 5 days now on the Dow. The US 2-year Treasury yield saw its biggest 3-day decline yesterday. Now, there's definitely a pause in the rate hike. So that is one thing that the market is firmly betting on, that give and take all that's happened in the last 48 hours, the Fed will not go ahead with a rate hike in its March 22nd policy. So that seems to be something the market is working with. US President Joe Biden, of course, we'll talk a little more about that. He's assured depositors about the safety of the banking system. So that assurance has come through from the regulators, from the president. We saw what happened with HSBC, where they went and, they were the white knight for SVB UK. But for the Nifty itself, a lot of levels have been breached on the downside. In fact, the Nifty is now down 600 points from the March 8th closing level that we saw. And a couple of things to watch. We've sliced below the Feb 28th low. The next level would be the September 2022 low of around 16,800. I'm not saying we get there, but that is 16,800 to 17,000 is the next line in the sand for the market. So watch out for that. And the 200 DMA on the upside will act as a key resistance. So these are the markers. Even if there is a bit of a relief rally today because of what the SGX Nifty is suggesting and post the comments from Joe Biden, the sell-on rally is something that could play out. So caution is definitely the name of the game in the market now. And, we have a lot of big events coming up. There's a lot of US data, etc. There is the FOMC policy. Ahead of that, I think no aggressive bets would be taken. But I won't be surprised at any point in the day if once again, the sell-on rally trade plays out.
Oh, yes, that was a problem yesterday, right, Sonia? Because despite what the Fed said, despite what the Treasury said, the markets just didn't want to listen. It was a mini tantrum of sorts. I mean, the way I saw it, especially in the afternoon with European bank stocks falling, 7, 8, 10%. These are large corporations that we're talking about, the likes of Credit Suisse. I think what really helped stem some of that absolute panic and mayhem was the statement from the US president, where President Joe Biden assured Americans that the U.S. banking system is safe and that depositors would have access to funds when needed. Let's just hear out that comment once, and then we continue our chat.
All customers who had deposits in these banks can rest assured, rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers.
That's a reiteration coming from the U.S. government almost on an hourly basis in this crisis. In any case, it really helped the dollar pull back. The dollar was slumping, remember, at this time just yesterday. And now again, it's heading towards that 104 handle. So there's some sort of cool off in just the level of risk in the market, the level of panic in the market. There we go. We're approaching the 103.8 level as of now. Just a word on inflation here in India, and it goes to show that this is a long drawn battle. It's nowhere close to completion. Look at the numbers. The numbers are still elevated. Inflation is extremely sticky. It's only a minor, snitch below the January level at 6.44. It was above street estimates for sure. And the problem is that core inflation has not moved at all. It's extremely sticky and rigid at 6.1%. No let up in core inflation. This is something that's going to play on the RBI's mind. We'll see how Indian yields react to this. Though, of course, overall, there is a cool-off in yields because of the anticipation that the Fed is going to take its foot off the pedal. So that's something to keep in mind. I'd like to end by just pointing out banks. And that's the one pocket of the market that at least I will watch extremely closely, because banks have led this decline this year, this month. Whether you're looking at the Nifty bank or the PSU banking index or the private sector banking index, there is a lot of sort of chaos that's played out in bank stocks, especially in the last 2 or 3 days. At some point in time, as Prashant said, perhaps this is getting a little excessive because there's no one-on-one correlation between what's happening in India and what's going on in US banking. So at some point, perhaps money starts trickling back in. And we know the moment money comes in banks, that tips the needle for the overall market as well. So I'll watch out for that.
Do you guys remember the UK pension crisis, right? Yeah. Recently, the pound was selling off for about a week or so. And it seemed so intense when we were living through it. And it lasted basically a week. The Bank of England stepped in. They provided liquidity. And then went on their business of hiking rates. That's the normal world we know, which is central banks increasing interest rates. I think Neelkant makes a very good point. We're going to put that quote out that some of these accidents are bound to happen when you increase interest rates at such a fast pace.
Frenetic pace, absolutely. And interest rate sensitives, not just banks, right? If you look at the performance this month, auto stocks also down quite a bit. So all the interest rate sensitives, banks, autos, real estate, are under pressure in the last fortnight or so. But lots to talk about. It was a very disappointing day yesterday. It's a 5-month low for the market. And let's see how today shapes up. At least the SGX Nifty is indicating a start in the green, but this has been a sell-on rally market. On the equities front, we have a comment coming in from Neelkant Mishra of Credit Suisse. He says the severity of contagion triggered by the run on US bank SVB and its closure last week will depend on regulatory decisions, like if depositors will be made whole immediately. But were SVB's troubles idiosyncratic, like an undiversified depositor base and no rate hedges, or should we fear more accidents? To which Neelkant says we should fear more accidents. So definitely this is not the last of it. Perhaps there could be more coming. And now they're talking about, not just a recessionary situation, but also perhaps layoffs in the financial space in NBFCs, etc. So that's the next big thing to worry about.
Oh, absolutely.
And something we have enough to worry about already.
All right, let's get you some money market views now as well. On the rupee, this is Bhaskar Panda of HDFC Bank, who says that the collapse of Silicon Valley Bank has had major impact on not only banking stocks, but has also forced a rethink on US Fed action on interest rates, causing major volatility in US yields. He says dollar index down and a shift to safety is in vogue now. Given this global backdrop, he adds, the USD INR pair rallied from around 81.72 to close above the 82 to a dollar mark yesterday, which means the rupee actually weakened quite a bit by close. He says uncertainty would make it even harder to make directional calls now. Hence, expect the USD INR pair to remain volatile and trade in a range of between 82.2 to 82.5 to the dollar.
And on bonds, Mr. Bhaskar Panda says that benchmark yields reacted to major moves in US yields and therefore moved down. He says any further down move will be event-based, but he feels the 10-year benchmark will now consolidate within a range of 7.35 to 7.4% for the day.
All right, we do have a lot of stock-specific action to track today, so we'll get straight to that in a bit in our special Top 10 segment. We're looking at Sona BLW. Remember, there was that big exit from Blackstone yesterday. More on that in a bit. Bharti Airtel, GAIL, Lupin, Tube Investments, Asian Paints and Indigo Paints. That's on our radar on the back of positive news flow. Mahindra CIE, Mahindra Logistics, a lot of Mahindra Group stocks, and ONGC also on our radar, likely to open in the red. But first up, we have a view coming in from Rana Gupta. He's the portfolio manager, India.